Welcome everyone, and thanks for joining me today. I'm Robert with Open Lane Funding, and we're going to walk through what's happening right now in the real estate market, where I'm seeing the best opportunities for investors, and how to think about financing in this environment. What we're going to cover are current rate projections, the strongest markets to buy and invest in, where we're seeing the most appreciation, rental demand and vacancy trends, foreclosure trends and what they mean, and the key economic indicators that actually matter for investing decisions around real estate. I'm not going to talk about everything else. We're just going to keep it disciplined, right? Just to what affects real estate. My goal is by the end of the session, you have a clear picture of where to buy and what to buy and how to structure your financing in 2026. Let's start with everyone's favorite topic, rates. On the conventional side, most forecasters have the 30-year fixed hovering around 6%. Uh, don't think of it as upward or downward trend. Think of it as a sideways trend. All right, maybe slightly lower, but 6 to 6.4% is where everybody's projecting this to be. DSCRs are going to be in that same ballpark. All right, that with the best DSCR lenders out going to be for the top tier candidates about 5.875. It's going to vary case by case. You know, as a mortgage broker, I have the opportunity to find and customize these transactions to what works best for you. We just have to talk and go through it and say, hey, this is why I don't like the loan, and I'm here to help you, right? I'm here to fight for these lenders or fight with these lenders for you, right? A lot of bridge, short-term, transactions along with, commercial DSCRs. They're going to be in the high eights, low tens starting out. Sometimes can get lower. Sometimes they're going to start higher. It's going to depend upon the complexity of the project, leverage, a lot of asset stuff, right? So what does this mean for you as investors? Underwriting says to be disciplined. Even though some lenders are starting to loosen up and make more exceptions, underwriting still has to be disciplined. So you're still looking at appraisals for the most part. You're still looking at 3 to 4 weeks. There are lenders that are starting to speed this up, right? Starting to loosen up again, but they're overall sticking with being disciplined. Pricing is being adjusted nationwide, so you're starting to see some lenders as these come down. They've already came down as well for these investment lenders, and they're pretty much going to plateau along with the market rates. So don't expect these DSCR rates to plummet anytime soon. As of 2026, well, all the experts are thinking it's not going to be very much different. Maybe a quarter point either way. From this point, let's talk about where the opportunities are, right? The national best places to invest and which markets you need to start watching. These reports are consistently highlighting a few themes: affordability, job growth, inflows of people, and businesses. On the Sunbelt and Southeast Texas front, you're looking at Dallas, Fort Worth area, Houston, Nashville, Atlanta, Georgia, Tampa Bay, Florida, Jacksonville, Florida, right? So these are some of the hot areas, and those are some pretty big markets as well, right? Dallas, Fort Worth, that was massive. Houston's massive, and Texas is a great state for investors. It's very investor friendly. So is Florida and Georgia. Uh, what these do, well, the reason why these are strong, right, is they all combine strong job growth, their business friendly environments, and growing populations. This is exactly what you want behind your rent rolls and long-term appreciations. We're also seeing a lot of love in the Midwest and interior value markets like Indianapolis, Toledo, Grand Rapids, Milwaukee. Those are another big markets to really start getting into. These are places where gross yields can be higher, price points are still accessible, and you're not competing with as much institutional capital as in the major coastal markets. That's massive. You're not competing with Wall Street, right? If you're looking for a quick mental framework, think Sunbelt growth for appreciation plus population, and Midwest value for yield and stability. Now let's narrow in on appreciation. All right, recent hottest markets rankings for 2026 keep putting Hartford, Connecticut, Rochester, New York, and Worcester, Massachusetts near the top for the expected combined sales and the price growth, and some in the mid teens to high teens percentage rate for when you blend the value of and prices. These markets are benefiting from spillover demand out of pricier metros, still more reasonable baseline prices, so that's always great. These are also set of refuge, quote unquote, of value plus growth markets. Toledo, Ohio, Providence, Rhode Island, Richmond, Virginia, New Haven, Connecticut, Pittsburgh, Pennsylvania, and Grand Rapids, Michigan. Out of these, even though they're seeing, value plus growth markets, I would kind of stay away from Pittsburgh. Any pretty much anywhere inside of Pennsylvania. For those of you who don't know, even though this market says this is a good growth area, Pennsylvania is really really hard to invest in. And Pittsburgh is insanely impossible to grab contractors if you're not local. If you're local, it's all you. But if you're not local and you're looking for somewhere, I would stay away from Pittsburgh. It's very very tough. So if so if you're also building a multifamily market or multi-market portfolio, one strategy is balancing these higher growth refuge markets with more cash flow heavy Midwest and Southwest or Southeast markets. Let's move on to the rentals because that's the oxygen for your DSCR and cash flow deals. Across the 50's largest metros, the average rental vacancy recently hit about 7.6, up from 7.2 the prior year, and above the pre-pandemic average of roughly about 6.9%. Translation: nationally, we're transitioning from a heavy landlord-favored market toward a more balanced, even renter-friendly market. A lot of that is driven by a big wave of multifamily supply in the Sunbelt markets, combined with a cooling in household formation. But keep in mind, there are still markets, think coastal hubs like Boston, San Jose, New York City, where vacancy is below 5%, and the landlords still have a strong pricing power. Uh, you know, if you're looking to be in those areas, I would probably stay away from New York City. A lot of you guys, I don't know if you're paying attention, but they're talking about putting a lot of restrictions on landlords, right? And they already have it, but they're gonna increase it, and they're gonna make it really hard for landlords to make any money. So in those areas, I would stay in Boston and San Jose because it's going to be a little bit more landlord friendly, even though the landlords have the strength, quote unquote, and stronger pricing power. New York City still, especially with Mondani getting in there, they're going to really make it hard. They're trying to take over these big multifamily buildings and all these landlord areas in New York City and try to make it state controlled, which is a nightmare for local investors. So I would avoid New York City like a plague as an investor. There's other places in New York, if you like New York, that are good for investors. It's just New York City itself I would stay away from. As investors, this means you need to underwrite more conservative rent growth assumptions in high supply markets, but you still need to find strong demand dynamics in select coastal land and land constrained metros. Got to promote my Harley mug. A little coffee never hurts anybody. All right. Now, let's go up to foreclosures because everybody wants to know if there's a big wave of distress if it's coming or not. Year-end data for 2025 shows about 367,000 foreclosure filings, which is roughly about 0.26% of the U.S. housing units. And that's up about 14% year on year. That's a meaningful increase. but still well below the 2019 levels and light years below the 2008 crisis. So that's great. That's showing more, for you investors, that's showing more opportunities, right? But it's not going to really affect, the housing market like the '08 and the 2019. You're still going to have that consistent ability to have appreciation, especially in the markets that we've already addressed that are appreciating the highest, right? Early 2026 numbers show foreclosures have been rising year over year for about 11 straight months, with around one in every 3,500 units having a filing in January. Starts up about roughly 26% year over year, and completions close to about 59% again, directionally higher, but still from a historically low base. So that's good. On a mortgage performance side, overall delinquency rates are in the low 3 to 4% range, with serious delinquencies near 1.1%, which implies more of a normalization of ultra low delinquency years rather than the systematic crisis, as at least so far. There's still more to come, right? We're only in the beginning of March. For investors, that suggests more selective distressed opportunities, not a tidal wave, but pockets of motivation where you pick up deals, especially in markets where higher consumer strain or heavier taxes and insurance burdens. Now let's zoom out. Let's look at the macro picture, because this is ultimately what drives rates, rates, and risk appetite. On the Fed policy, the Federal Reserve held rates steady in January, after implementing cuts in late 2025, and their message has been very clear. They're cautious and data dependent. They're not going to rush in and slash rates aggressively as long as inflation is running a bit above target and the labor market is cooling gradually, not collapsing. This means that we should expect a slower, measured path from here and not a rapid pivot. And that's even, as they were placing the Fed chair, right? When Trump puts his people in there, it's still going to be there. It's still unknown where he's going to be at, if he's going to cut rates or if he's going to increase inflation, because it sounds like he's going to be selling a lot of bonds. So that's going to, do a lot of, possible damage, to the short-term growth. So don't think that just because a new chair is going to come in, that things are going to change. So just expect a horizontal, right? It's going to be fluctuate, a quarter point here or there. It's going to go quarter point up, quarter point down, or remain the same. So don't expect anything crazy. On inflation, the Fed's preferred measure, core PCE, has come down significantly from its peak and is running in the upper 2% range, around 2.8% year over year recently, with some forecasts putting in inflation closer to the low twos by low 2026. So we're on the right trajectory, but not quite at the finish line from the Fed's perspective. In terms of jobs, the labor market has clearly cooled, with late 2025 monthly job gains much weaker than the boom years, and unemployment projected to sit in the low 4% range through 2026, softening, but not an outright recession and in most baseline forecasts. And I'd also like to know, in that I'll have to do some digging and let you guys know next week, but the low 4% range for unemployment, how much of those are still in the job market? Because a lot of you that don't know, after a certain amount of time of being on the unemployment, they take you out of the job market, meaning you're not unemployable, right? So they don't count you as their numbers. It's a way to make it seem better, but that is generally higher. So I would like to know if there's a way I could find that out. I'm gonna have to use some good old Perplexity or a different AI engine to figure that out. For housing, most large-scale forecasts call for a flat, modest pause Oh my goodness. Modestly positive national home price growth, roughly 0 to 4% in 2026, and a pickup in transaction volume as mortgage rates edge down and inventory loosens up. That's great. It used to be inventory used to be very, very tight in 2025, so it's finally starting to loosen up. We're finally starting to, uh, build some momentum. The big message, the macro backdrop looks more like a slow grind normalization than a boom or bust. For savvy investors, that's actually a great environment to accumulate assets while the competition is still hesitant. It's always a market of when to buy, right? Whether you're buying and holding, right? Holding for appreciation, holding for rates to go down, whatever it is, you know, you get into it while, you know, the higher the rates, the lower the price. The lower the rates, the higher the price. So it's always the time to buy because there's always, you know, there's always a positive for what you're looking at. Now, given everything we've just covered, here is how I think about positioning in 2026. Focus on cash flow positive deals that still pencil at today's DSCR and Non QM rates with at least a modest cushion for vacancies and flat rents in the near term. Target growth plus value markets. For example, pairing Sunbelt growth markets with Midwest value markets in your portfolio. It's always smart to diversify. Anytime that you've talked about anything, like if you look at, just stock markets and then you really expand off of that as well, diversification is how you stay in the game, right? Underwrite conservatively on rent growth. Don't think that you're going to buy this property, it's renting at 1,500 a month, and you're gonna come in there, and then you're just gonna jump the rates up. You're gonna scare away the renters, right? That's kind of a lot of these markets being more renter friendly. You're not gonna have the ability to do that. So be more conservative on that growth, especially in the metros that have a lot of multifamily supply coming in online and rising vacancies, right? Keep an eye out for selective distress. Owners squeezed by higher taxes, insurance, and or short-term debts resets, rather than betting on nationwide foreclosure wave. Right. So focus on select properties. Don't just you know think this is all going to work nationwide. You're going to have to focus and find your target markets and stick there. Find something and make that blueprint that works. And I can help you with that. We can talk about ways to go over that and ways to find that. You just let me know, and I can figure out a way for you, and I can help you build that blueprint. On the financing side, this is where a broker like me at Open Lane can really add value. We're always structuring DSCR loans, non QM products, commercial financing that matches your strategy. I try to, in short term bridge, those are always some of the easiest that everybody likes to do. You just let me know what I can do for you, and we'll get rocking. I appreciate everybody being here. If you have any questions, please give me a call, shoot me a text message. That number is 208 215 9936. Or you can shoot me an email at rhopenlanefunding at outlook.com. Thank you, everyone. Have a good Monday and enjoy the week. I hope it's successful for you.